Welcome to this Killick Explains video, and the title of this video kicks us off on a new series. It's Back to Investing School. What is profit? Because you'll be watching this at the start of what is a new school year, so let's get into some investment basics to set the scene for the rest of it. So basically what I'm going to do with this series is refresh what is profit here, what are assets in video 2, and what is cash flow in video 3. The kind of three core planks, if you like, of understanding an investment in shares, in equities, as they're called. So, first point, back to basics, if you like, share prices are fundamentally driven by profit. So the reason I'm going to talk about profit first is that it is arguably the key number, and it's the one that investors watch the most closely. Now, there are several versions of profit, and that's a key plank of this video. So in conceptual terms, it is simply revenue or sales minus costs. All right. And if you want to express it as a margin, you can simply do it as a percentage of revenue or sales. You've got the absolute profit number, 10 million for argument's sake, and that as a margin or percentage of revenue, 14, 15%, 25%, the better the business, the higher the number. So let's look at the various different profit snapshots you can take away from a company, an analyst report, or a set of accounts. Top of the list is what's called gross profit. So what I'm saying here is there are different ways to talk about what profit actually means. And gross profit is sales revenue minus what are called cost of goods sold. And that is to say, the direct costs of making a sale. So put simply, if you're, say, Marks and Spencer's selling sandwiches, it is quite literally the difference between what you can sell that packet of sandwiches for and what the direct input costs were, including the packaging, the sandwich itself, the cost of getting it to the warehouse and out the other side, and so on. And it's basically, as a margin, the gross profit margin, a good safety measure. It tells you whether a company will be able to weather what I call bumps in the road. It's literally what Terry Smith calls a margin of safety measure, but it's not the only one. So we could move on. We could look at what's called operating profit, or EBIT, earnings before interest and tax. And that does what it says on the tin. That is sales revenue minus all of the direct and indirect costs required to run a business, if you like. So here we're deducting not just the packaging, if you like, and the sandwiches themselves, but also overheads, lighting, heating, rent if relevant, salaries of staff that don't switch on and off with sales, and so on. We're not including interest and tax. More about that in the next measure. So what we've got is the operating profit or the operating profit margin, and that's quite a good snapshot on efficiency, because what we're saying here is, yes, it's great to make a gross profit margin from our basic day-to-day trading, but actually as a business, we've got to factor in overheads, we've got to factor in indirect costs, and the operating profit number, or EBIT as it's known, or PBIT, lots of jargon, profit before interest and tax, is that snapshot, and analysts watch it quite closely. But it's not the end of the story, because arguably the profit number that matters the most, if you're an income investor, for example, is the one that is stated after everything. So there is a thing called net profit, or profit after tax, which is sales minus those direct costs I talked about to get to gross profit, minus the overheads I talked about to get to operating profit, and also minus interest charges. That's the bill we're paying for financing the business, if you like, using debt, and tax. Because you can't ignore tax. The tax rules are different to the rules that accountants use to put together profit numbers, but nonetheless, arguably you can't ignore them altogether. And once you get down to the net profit number, then the business has a decision to make. Are we going to reinvest that, or are we going to distribute it as a dividend? So for income investors, it's a fairly key number because it's the number out of which their distribution will be paid. It's also key to something called the PE ratio. It's the E, the earnings number, in the commonly quoted price to earnings ratio, which is a snapshot of is a stock cheap or expensive. Now, I want to finish off by just saying, watch out. The measures I've mentioned so far, gross profit, operating profit, net profit, are all valid. They're all published. They are all numbers that companies have to, by law, tell you about. But there are some other ones. Management teams can be crafty. They can be clever. They can say, don't worry about those because those aren't as flattering as we'd like them to be. I'm being cynical. Have a look at our special profit number. All right. Have a look at our trading profit number. Have a look at our core profit number. In other words, they start using language which actually isn't a legal requirement to put a profit number in front of you which supplements, if you like, the ones they have to publish and tries to paint a better picture than perhaps is realistic. So watch out for that. Watch out for inconsistencies, all right, in the way that profits are presented, revenues and costs are matched up, and watch out, as I say, for management motivation. In other words, keep a cynical eye open for companies that try to persuade you to look at something which is not a legal or statutory profit number and look at something which they prefer you to focus on instead. Okay, if you'd like to know more, that was just a snapshot. There are other related videos at killick.com/resources. You can also pick up some of that stuff in a bit more detail in my guide sitting next to me, How to Invest in Equities, which is available at the same place in digital form. And then, of course, there's our quarterly magazine, Confidant, where, amongst other people, our research team talk quite often about some of this stuff in a commercial context.